Okay, dear students, this is Mustafa Ahmed Mirchawala, your FR trainer, and today we are going to discuss the latest past paper of September December 24, the final account question. Okay, as you all know that ACCA disclosed only the last 40 marks, so we are going to solve one of the question, that is final account. And yes, this question is for your motivation. You will see that you have done everything majority, I won't say everything, whatever I will discuss, okay. So before we move on, let me show you some of the latest results. You can see we have prepared many lists. In the list one, there are students with 80s, in 80s, 70s, then we have a lot of students in 17s in list 2, then 60s, then finally like this. Okay, so these students also studied in the same way as you are doing. They followed the instruction of the teacher, they completed the course on time, they read the articles of given on accglobal.com, they practiced last 40 marks on the exam software, they did study hub, that's very important. Okay, so if you follow all these things, you can also score very good, you can also score excellent, right? So now, without wasting any time, we'll move on to our past paper. First of all, what's my strategy? I'm going to discuss with my pen. I will show you sketches and I'll teach you in my style, okay? Then we'll shift to the software thing and the Excel thing, and then I'll solve it, okay? So as you are used to with the pen thing, that's fine. Now, so now you have given you can see a trial balance. First of all, in financial reporting paper, always see the year end. The year end is very important. 31st December x1, 31st December x1 is your year end. Okay, so we have, see, this is the trial balance, and in the trial balance you can see draft profit before tax. This is the profit before tax, and the retained earning is given separately, and retained earning is given at 1st January x1. So this is opening retained earning, this is opening retained earning. That means first we need to adjust this profit, first we need to adjust this profit, and once you will correct this profit, then you will add in opening retained earning, finally you will get closing retained earning. And yes, closing retained earning goes in your SOFP. So in this question you have to make a little income statement thing like profit reconciliation thing, as well as you need to make SOFP. Okay, let me still show you, let me show you the requirement. See, calculate using pre-formatted table provided. This will be given to you ready-made. Companies, Newcraighall companies adjusted profit for the year ended 31st of December X1. For the year ended 31st December X1. Okay, you need to calculate the profit. So let's start with adjustment number one. Let's start with adjustment number one. Okay, keep accounting period in your mind. Accounting period is 1st January x1 to December x1. Okay, now this first part is linked to IS 23 borrowing cost. Borrowing cost, you can capitalize borrowing cost in some cases. On 1st July x1, that is the mid of the year, new company received a 5 million 8% loan. They have taken loan which was accounted for correctly. That means the initial loan is accounted for correctly, no problem. At that date, it is due for repayment in 30 on third after many years, after like 4 or 5 years. So it's a long term loan, it's a long term loan, it's a long term loan. Okay, the interest is payable, the interest is payable annually in arrears, the interest is payable annually in arrears. That means wait, they have taken loan on 1st July, so next payment will be due on 1st of July x2. The interest payment, the next physical interest payment will be made on 1st July x2. Okay, after 1 year. But your accounting period year end is 31st December. Your accounting period year end is 31st December x1. So if you have a common sense, if your brain is active, so at the year end your year end, your accounting period end is after 6 months. So at the end of 31st December X1, you need to book 6 months accrual. You need to book 6 months accrual in your current liability, accrued interest in your current liability, and I'll do it. I will do it, that 6 months accrued interest in the current liability. Okay, be careful. This is very important. Now, the 5 million was used to fully fund the construction of a new building. Okay, this is qualifying asset. Qualifying asset. Remember, qualifying asset by definition. In IS 23 you did this definition. Qualifying asset is an asset that takes substantial period of time to complete. Remember? Okay. So yes, we have taken a specific loan to construct this qualifying asset. Okay. Now the construction cost has been correctly capitalized, but no other accounting entries in respect of the property or loan have been made since that date. Okay, so the 5 million was the initial amount. The 5 million was correctly recorded in asset. The 5 million was correctly recorded in property. See, this is the property. This is the property. In this property they have already recorded 5 million, means 5,000 they have already recorded correctly, no problem. But they are saying no other accounting entries in respect of the property or loan have been made. So it means they have not made any entry for capitalization of borrowing cost. You know, capitalization, you means it means this loan interest of 6 months will be recorded as an asset. Okay, capitalization means asset. The construction is due to be completed by 30. Perfect. That means our year end is 31st December X1. So by this date construction has not yet been completed. So we are perfect for the capitalization like this. See, June, July, August, September, October, November and December. So right from 1st June construction started, that means all conditions are met. June, July, August, September, October, November, December, and the project will be completed in January next month. So these 6 months are perfect for capitalization. Perfect for capitalization. That means these 6 months interest will be capitalized without any issue, but we will do it ourselves because they haven't done. So let's do it. Let's do it very simple. It was a 5 million loan. 5,000, 5 million means 5,000 into 8% into 6 upon 12. Okay, 5,000 into 8% into 6 upon 12. 200. So this 200 is your capitalized borrowing cost, and you know the entry normally we make the entry interest expense debit and liability because accrued interest not yet paid, interest expense debit and accrued interest credit. But right now this interest is going to be capitalized, so we'll make the entry like this. Although the entry is not required in the exam, be careful. Property debit 200 and accrued interest which is your current liability credit 200. Property debit 200 and accrued interest which is your current liability credit 200. Okay, so my dear respected students, this property balance will be added by 200. We will increase this property by 200. Why? Because they have initially accounted for the 5,000 initial construction cost has been accounted for correctly. Initial construction cost has been accounted for correctly, but the interest they have not made any entry for interest. So for accrued interest we need to make the entry. For accrued interest we need to make the entry. For accrued interest we need to make the entry, giving you like 1 minute to read it. Please read the adjustment number 1. Also I would say take the picture because soon I will change the screen, and that in that screen there will be no question. Okay, so please read it. Okay, now next thing, the construction. Okay, now note number 2, next note, you will see one error now. On 1st December X1, be active. On 1st of December X1, new company placed an order for equipment at a cost of 3 million. They have just placed an order. No payment has been made. Just placed an order. This cost was included within equipment and trade payable. The equipment was received and paid on 6th January X2. That means you didn't get any control. Just think, the delivery has not yet been made before the year end. So this is not your asset. You get the control. You get the control of the asset once it comes to your premises. Then you make the entry PP debit or liability credit or PP debit or payable credit. So you just gave an order on the phone. You just gave an order on the phone and you are saying, that that I'm going to book the asset now. No, you can't. You cannot book the asset. You cannot book the asset now. You are not supposed to book the asset now. So this stupid person make this entry. Just listen. He made the entry equipment debit 3000 and current liability or trade payable, whatever suits you. Trade payable credit 3000. So this is the wrong entry. I am saying this is wrong entry. No need of this entry because this entry will make next year. We received the asset next year. See, the asset is received. The physical delivery we got on 6th January X2. So next year we need to book it. No need to book it now. It was just an oral order. Okay. So this entry will be reversed. So what we'll do, my dear students, see, we'll go in this equipment. See, this equipment balance is 16,200. We'll remove 3,000. We'll simply subtract 3,000 from this, and also the trade payables and current liability will be corrected. We'll also remove 3,000 from current liability. Okay. So we have done like 2 adjustments. Don't worry, we'll be doing it on Excel as well. Now, the third thing is property. Property includes land of at a cost of 12 million. So be careful while doing depreciation that we need to remove just for the calculation, just for the purpose of calculating depreciation expense. We will be removing this 12 million. Okay, this is land. Now, what is the property depreciation? It's a straight line over 20 years. Equipment is diminishing balance, reducing balance 25%. And there is one thing, right of use of asset, leave it. We'll do it. Now, let me do something for you guys. I can calculate depreciation expense orally. Just we are doing rough working right now. We'll do it fair afterwards. So, see, if I want to calculate depreciation of property, see, if I have to calculate depreciation of property, so initially the the property amount is 32,500. Now wait. This 32,500 includes 12 million land, which we should never depreciate. So remove it. Okay. And yes, this include 5,000 of that construction cost. 5,000. Remember the IS 23 thing. And that 5,000 construction cost should not be depreciated. Why? Because the project has not yet completed. Project is going to complete next month after the year end. That is 31st of January X2. Okay. So we must remove that 5,000 also from this and now divide it by 20. It's now divide straight line method, divide by 20 years. Okay. So when you divide it by 20 years, this will be 32,500 minus 17,000 divided by 20. No. It's going to be 775. Okay. And if you want to do this in millions, so it will be 0.775. Right now it's in thousands. it's in thousand, so it's 775, right? Okay, right, keep just telling you this depreciation. And yes, this depreciation is an additional expense which has not yet booked. So in the profit reconciliation, the 7 mark requirement, please don't sleep. This depreciation expense will be deducted. This depreciation expense will be deducted. Okay. Now, one more thing. Then we need to book depreciation of equipment. So you have, wait, let me write equipment. Equipment is reducing balance method. Diminishing balance is reducing balance method. Okay. So reducing balance method is cost less accumulate. You have a cost of 16,200. You have a cost of, see the cost is 16,200, but yes, there is an error of 3,000 which we must remove. Okay, minus your accumulated depreciation at the beginning of the year is 84,200, sorry, 8420. Now this is your NBV. See, cost less accumulated depreciation is your NBV, now multiplied by 25%. So you will be getting depreciation of the equipment. I'm not writing it right now, I'll calculate it for you in the Excel easily. Okay, so this is how we'll do equipment depreciation. This is how we're going to do equipment depreciation, right? Then, so just giving you 1 minute to read it. If you want to read it, then I'm gonna move towards the next adjustment. So now we have adjustment number 4. This is linked to IFRS 9, but be careful, they are talking about financial assets. We are not taking loan, we are giving loan. So if you remember my classes, then whenever we give loan, so we start the amortized cost table with the net cash outflow, how much cash went out from our pocket. Okay, so let's see. The financial assets are 3% bonds. Okay, this is coupon rate, okay, that were acquired for 3.5 million. Now wait, there should be the first entry is like this. You have given loan, so cash is gone, and in return you get a receivable or financial asset. So the first entry should be financial asset debit 3,500 and cash credit 3,500. This should be your first entry. On first day, and which can intends to keep until maturity. Okay, the business model is clear. The business model is held till maturity. Okay, right? So it's a perfect match for amortized cost accounting. Now see, this guy did one blender. Transaction cost of 0.5 million were acquired, incurred. The bonds were capitalized for 3.5 million and transaction cost were expensed. This is wrong. As this is a long-term investment, so this transaction cost we need to spread. We are not supposed to book this transaction cost immediately as an expense. This is wrong. So what exactly we should make the entry? This financial asset, this should be capitalized. This 0.5 million means 500. So financial asset debit and cash credit. But this stupid accountant, they made the entry P&L debit. He booked the P&L. So this is wrong. So see, this is one error. So now in the first listen, in the profit reconciliation, they have booked this expense deliberately. Now if I reverse this expense, so it will increase your profit. So I will increase the profit by 500. One thing this I will do. Okay, second thing, now just think, my amortized cost table should be started with the net cash flow. So this is 3,500 outflow and this is 500. So amortized cost table should start with 4,000. Okay, now the bonds have an effective interest rate of 7%. Newcraighall company received the annual receipt of 105,000, that is physical interest, and recognize this as an income. Okay, so this person has only recognized the income of how much? 105. Okay, so what we'll do, listen, let me teach you in a very simple way. 3,500 was the initial amount, then 500 was the transaction cost, sorry. So this is the 4,000. 4,000 multiplied by, first let's do interest income. Interest income is always booked using effective rate. So effective interest rate is 7%. Okay, so 4,000 multiplied by 7% is 280. 4,000 multiplied by 7% is 280. 4,000 multiplied by 7% is 280. Okay, now less physical interest. How much is the physical interest? 105. Can you tell me the closing amount, closing asset for SOFP? I'm asking about closing asset for SOFP. 4,000 minus 280, 4,000 plus 280, 4280 minus 105. This is 4175. Okay. Now this will go in the SOFP. This will go in the SOFP as a non-current asset. This will go in the SOFP as a non-current asset. Okay. You must know this accounting. IFRS 9, right? And we have not taken loan. We are giving loan. Investment. We are doing investment, fixed rate investment. Now, can you tell me what should be the impact on income statement? That profit? Yes. They have already recorded this 105. Out of this 280, already 105 is already recorded as interest income. So can you use your brain? 280 minus 105 is, I think, 175. Yes, 175 extra interest income we'll book. 175 extra interest income we'll book in the profit reconciliation. 175 extra interest income. Why? Because out of 280 they have already booked 105. They have already, see, it is written, see, recognize as an income, it is written, see. So out of 280 already 105 has been recorded as an interest income. So remaining 175 we should book. Okay, so I'll be doing it. So in this point number 4, what corrections for income statement? Listen, 500 transaction cost, it's a wrong expense they have booked, so we'll reverse it. So we'll increase the profit by 500, and then we'll book extra additional interest income, this 175. These two things for income statement, and this is for SOFP. This is for SOFP. That's it. This is for SOFP. That's it. Use your brain. Okay, now finally the last major transaction is IFRS 16. Then you will have a very little 1 minute of few seconds transactions. Listen, on 1st January X1, first day of our accounting period, new company entered into a 5-year is important, lease of equipment. The equipment had a useful life of 5 years. Okay, so lease term and life is same. So for depreciation purpose, we'll divide it by 5. We'll divide the asset by 5. Now new company will make 5 payments of 2.4 million on 1st January each year, including on the commencement date. That means first payment now. You better know this case. First payment now. Okay, right? Immediate payment. And from the next year, every year on the first day, first payment now, and every year on the first day, payment date. Now using the implicit interest rate of 13%, present value of future lease payments after the first payment. See, read the words. Present value of future after the first payment was made is 7.139. That means this 7.139 does not include this first payment of 2.4 million. 2.4 million. So what does it mean? Let me, as you know, I teach with sketches. I teach with sketches. So let me make sketches for you. So it means this is year 0, 1, 2, 3, 4, and 5. Okay, 5 years. So the present value of all future cash flows excluding this is 7.139, 7.139. But my dear student, future cash flows present value is 7 point, but there is a cash flow of 2.4 million here as well. So you know the cash flow which is given now has the same has the same present value. So what is the total present value of all cash flows, it will be 2.4 plus 7.139. This I'm telling you for the asset thing. Okay, so 2.4 plus 7.139, it's going to be 9.539, 9.539. So initially the entry will be ROU, right of use debit, 9.539, and lease obligation credit 9.539. Okay, but you are doing first payment now, so immediately you'll make one more entry, LO, lease obligation debit 2.4, and cash credit 2.4. So my dear student, listen, for the purpose of depreciation, don't forget, for the purpose of depreciation we'll depreciate this thing. For the purpose of depreciation we depreciated ROU, but there is a schedule of lease amortization schedule, remember, through which we calculate interest. So lease amortization schedule will start from this minus this, the net amount. Lease amortization schedule will start from the net amount. Don't worry. Okay, that is 7.139, right? Now just giving you 30 seconds to think, over it, everything is in front of you, giving you 30 seconds to think over it. Okay, now quick steps. First of all, depreciation, we'll depreciate ROU, and the life is 5 years, lease term and life is same. So there will be a quick depreciation ROU of 9.539. I'll do it everything in the Excel as well, divide by 5 years. So this will be your depreciation, and yes, this depreciation will reduce your profit. In the profit reconciliation. Okay, now one last thing, you will make a lease amortization schedule, but no need to make it formally. Just tell me your opening lease balance is 7.139, 7.139. Okay, 7.139 is your opening lease balance. This 7.139 you will use for the whole year. This is your outstanding balance for the whole year. So you'll apply interest expense. I think, what is the rate of interest? Interest rate is 13%, implicit rate is 13%. Okay, so 7.139, it's going to be point, tell me the date at which we started. It's 1st January x1. Okay, so it's going to be 0.928, 0.928, it's going to be 0.928. Okay, so now we have this 7.139 is the opening lease balance, then interest expense. If you add, listen to me, if you add these two, your total lease liability, first I'm using the word total lease liability, will be 8.067 something, okay? But out of this 8.067, this is total. Your you have to pay one more payment just after one day. This is 31st December. This is 31st December, but just after one day, you have to pay one more 2.4 million. So this is the current liability. This is the current liability. What about the non-current thing? What about the non-current thing? Now wait. Yes. 5.667 is your current, it's your non-current liability. Non-current liability. This is the non-current liability. Okay. So as you all have taken classes, this is the revision days class. So you must have this much knowledge. You have done already the standard. Right now I'm not teaching you standard. Okay. So this is how we'll work it. Now what you will post in the income statement right now in the profit reconciliation, this depreciation, the depreciation amount I'll tell you in the Excel, and this interest expense, these two things will go in the profit reconciliation. These two things will go in the profit reconciliation as a expense, means it will be subtracted. Okay, then this is going to be these two things, this current liability and this non-current liability will go in the SOFP, right? And definitely this ROU after deducting 1 year depreciation, this ROU after deducting 1 year depreciation will go in the SOFP. Very simple. This is routine IFRS 16. This is routine IFRS 16. Okay, now you will have very tiny adjustment, baby adjustment. Now next 6, the current tax payable was 1680. Just, this year tax will be paid next year, but you book right now, so there is no under over provision, nothing. Go and check the trial balance. So this is your expense. The entry will be P&L debit or tax expense debit, P&L debit or tax expense debit 680, and then tax payable current liability, tax payable current liability credit 680, P&L debit or tax expense debit 680, or tax payable current liability will be credited. Okay, so how you will post it in the income statement profit reconciliation? In the profit reconciliation we will subtract 680 as an expense, and yes, this thing will go in a current liability, in the current liability year end SOFP. That's it. Okay, now the last point, number 7. In the financial IS 37, this is in the financial statement for the year ended 31st December X1, new company planned to disclose a contingent asset relating to a court case. Initially it's a contingent asset. Initially they planned it as a contingent asset, that means disclosure. Contingent asset, that means disclosure. Okay, but on 30th December X1, a court ruled decision that new company would receive only 1 million. This is full and final now. That means virtually certain. This means virtually certain. When you get the court decision, that means it's virtually certain now. When you get the court decision, that means it's virtually certain now. Okay, so once it is virtually certain, you can record it as an asset. So what's the entry? Listen, it's like a receivable. Claim receivable debit. 1 million means 1000. 1 million means 1000, and your income credit 1000. Contingent asset is your income. Claim receivable debit and your income credit. Claim receivable debit, that is your current asset, and income credit. Claim income credit or any income credit. Okay. And yes, this income will be added in profit reconciliation. This income will be added in profit reconciliation. Okay, I'm just giving you hint because I taught you other things as well in my classes. Sometimes you get insurance claim which you receive is also contingent asset. So with insurance claim, I taught this entry in the class: insurance receivable debit and insurance income credit. So this entry is perfect. Okay, right? Now you can see both requirements. You can see both requirement. I'm going to do it with you very soon. So I request you to take the picture of the question, because now I will have question on one screen here, but you can't see the question anymore, the screen which I'm going to shift. So please, this is the first part of the question. If you want to take the picture, this is the trial balance. Take the picture if you want. Okay. Then my dear respected student, this is one more part of the question. Adjustment number 1, 2, 3. Adjustment number 1, 2, 3. Take the picture if you want, or if you have the question, then it's perfect. And then this is the last part of the question. Again, it's your wish if you want to take the picture. I would recommend you to take it. Okay. So I have discussed almost everything. I have discussed almost all adjustment. Even, should I say one thing? There are students, they can do the question themselves. The way I discussed with you, I have touched major parts. Now I'm going to solve it for you. Simple, right? But there are students, they can do themselves now. It's so much helpful. It's extreme help I have done already. Okay. So let me shift myself to Excel now, finally. Okay. So let's do some working and then we'll shift ourselves to the main sheet. Okay. Now, first of all, let me do something for the right of use. I have already explained you everything now. Okay. So present value of future lease payment was 7139. Present value of future lease payment was 7139, remember, and this was the future lease payment. So definitely first payment now should be added to calculate ROU. That was 2.4 million 2400. So now if you add these two, this will be your ROU, this will be your ROU, remember, and then you need to divide it by 5 to calculate depreciation, okay, right? This bracket close, divided by 5. Okay, so this is your depreciation. 1908 is your depreciation. 1908 is your depreciation. Okay, you simply have to divide it by 5. Remember the 5 years life. So can you tell me what will be the closing balance of ROU? See, this 7631 is the closing balance of ROU for SOFP. Closing balance of ROU for SOFP. Remember? Okay. Now let me do a little working for lease payable as well. Lease payable. Now I'm not talking about ROU. Now I'm talking about lease amortization schedule. Lease amortization schedule will start from 7139. Remember, I just taught you with pen. And then you have finance lease interest expense. Interest expense will be 13%. This multiply by 0.13. 928.07. Okay, now if you add these two, you will get total lease obligation. But from this total lease obligation, we'll subtract 2400, which is current. So what about the non-current thing? Non-current is 5667. Okay, this already I have done. These workings I have already done with you. Okay, now then we have, remember, there is a adjustment number 4. See the question, you have the question of financial asset, remember. So in the financial asset, 3500 was the initial amount. Then you need to add the transaction cost. Okay, now how much was the nominal interest? Nominal interest was 105. Okay, and the effective interest was 4000. Effective interest income was 4000 multiplied by 0.07, remember, 7%, 280. So let's calculate the closing. 4175. This working I have already done with you in the pen, with the pen sheet, remember. So now can you tell me where this 4175 will go? 4175 will go as a non-current asset in the SOFP side. Yes. And these two, see, 280 minus 105, 280 minus 105, 280 minus 105, which is 175, will be booked as an interest income, as an extra interest income. Why? Because accountant has already recorded 105 as an interest income, and total interest income which should have been booked was 280. So 280 minus 105 will be the remaining amount. Okay. Now, one more thing which I would like to share. As per trial balance, how much is the trade and other payable? It's 5780. Okay. Now, removal of equipment purchase. Remember, there was an error in note number 2. Note number 2. They mistakenly add a 3000 payable. They mistakenly add a 3000 payable. Remember, in the current liability, so we need to remove it. And yes, accrued finance cost is how much? Accrued finance cost of IS 23 was 5000. 5000 was the loan amount, multiplied by 0.08 into 6 upon 12. So let's do it. Equal to 5000 into 0.08 into 6 divided by 12. 200. Okay, so your final trade payable will be 2980. Your final trade payable will be 2980. Okay, so few workings I have done with you, and yes, some workings I'll be doing with the same question. Okay, in the main sheet. Now keep one thing in mind, you have the question. I told you to take the pictures. The question is very important. Now I can't show you the question. I'm on the other screen now. So my respected student, let me go with the profit reconciliation thing first. See, this is the first part of profit reconciliation. This is the first part of profit reconciliation. Now in this time examiner told you in the requirement that this is the ready-made sheet given to you. Sometimes they give you ready-made sheet and you need to fix the numbers. Okay, so draft profit before tax, see, go and see from the trial balance. Draft profit before tax, go and pick from the trial balance. It was 4420. It was 4420. Okay, now next thing is depreciation charge. Wait, let me enlarge it a little bit. Okay, that this is fine, I think. Depreciation charge on property. Okay, let me write here. On property, you have, I think, 32,500. 32,500 was the cost of property, minus 12,000 was the land, minus 5,000. Remember the construction cost. Construction, this I have already taught you. Construction cost, remember? And then you close the bracket, divided by 20 years. Okay, so how much is this amount? This amount will be 775. I've already calculated for you, but still, if you want, I can do it again. 32,500 minus 12,000 minus 5,000. Then you have bracket close, divided by, I'm writing minus 20 because I need answer in negative number. Okay, I need answer in negative. That's why I have written minus 20. So this is the depreciation for charge on property, already calculated, already I did for you. See, now depreciation on equipment, let's do it for you. Equipment depreciation was 16,200. 16,200 was the original cost, minus 3,000 was the error wrongly added 3,000. And then, as we have to do with reducing balance method, so in reducing balance method you need to subtract accumulated depreciation, which is 8.8420, which is 8420. Okay, bracket close, into 25%, 0.25. Okay, so let me do it for you. Equal, bracket open, 16,200 minus, minus 3,000 minus 8420, bracket close, bracket close, into minus 0.25, 25%, 1195. Okay. Now next is depreciation on ROU. Depreciation on ROU, I have already calculated, it's I think 1908. Depreciation ROU is 1908. Let me pick from somewhere. Let me pick from somewhere. 1908. Yes. This. I'm going to pick it from here. Okay. 1908 I have picked from there. Then transaction cost capitalized. Yes. Adjustment number 4. 500 was the error amount. They mistakenly booked transaction cost as an expense. I told you to reverse it. Reverse it. So 500 will be added now. Now, nominal interest on bonds. Both methods are correct. Listen, you can directly add 175, that's also correct, or you do one thing. 105 you can subtract, 105 you can subtract, and then you add 280. This is also perfect. See, 280 plus 280 minus 105 is still 175. So you can do it in two steps, or you can either do it in one step, directly add 175. That is also perfect. Be confident. Then lease payments. Yes, there was one error. Hope you remember. Go and check the question. First payment now. Listen to me. Listen to me very carefully. First payment now. The entry for first payment now is FL, lease obligation debit and cash credit. The entry for first payment now is lease obligation debit and cash credit. Okay. But they have booked as an expense. I go and check. Go and check adjustment number 6, adjustment number 6 or 5. It is written they have booked 2400 as an expense. They have booked 2400 as an expense, so we need to reverse it. This is a mistake. You can check it now. It is written. I think I didn't discuss this while doing the question, but it is a mistake. Okay, it is written clearly. Okay, now finance cost. I just calculated the finance cost for you. I just calculated the finance cost for you. Wait, let me move the screen for you. Finance cost is this. Yes, 928.07. Finance cost is 928.07. This is expense. Now then income tax expense. Yes, we all know 680. It was 680. 680. And yes, contingent asset. There was an income of contingent asset 1000. We just recognize. I just taught you 1000 contingent asset income. Okay. Just one thing I would like to tell you to concentrate. This 2400. What is this 2400? Remember, they paid first payment now immediately on 1st January X1. As they got the asset on lease, they paid immediately the first payment. And we all know the entry for first payment now is lease obligation debit and cash credit. But this stupid accountant made the entry expense debit and cash credit. So this need to be reversed. This need to be reversed. So finally, we have calculated 3009 as a profit. 3009 is your correct profit for the year. 3009 is your correct profit for the year. You have taken 7 marks. Students, you have taken 7 marks. Okay. Now next thing. Now we are going to make SOFP. We are going to make SOFP, but for SOFP, I'll do some more working for you for this. See this. For property, plant and equipment little working, ROE working I have already done. So let me do property, plant and equipment working, but you must have your question with you. You must have your question with you. You must have your question with you. Listen. See, now I'm doing working for property. I am doing working for property. Listen very carefully. What was the initial, what was the initial cost, what was the initial cost of property? Go and check the question. It was 32,500. Initial cost was 32,500. Okay, 32,500. Now, did we do any errors in the property? No. Yes, land is already included. Yes, land will go in the SOFP. Now we are not doing only depreciation. Listen, now we are not calculating only depreciation. We have already calculated depreciation and I'll use it and I will use it. Right now we need the closing correct NBV. So this 32,500 is perfect. It includes the land. I know it's okay. Yes, land goes in the balance sheet, SOFP. It includes the 5,000 construction cost. That's okay. Now add, sorry, from 32,500. You remember there was some construction, there was some capitalized interest cost. Yes, it was 200. I calculated for you 200 capitalized interest cost. If somebody has forgotten it, let me tell you, 5,000 multiplied by 8% into 6 upon 12, it's 200. Okay, now subtract 2 depreciation. Now subtract 2 depreciation. One depreciation is accumulated depreciation written in the question already, 9,200, and one more depreciation is for the year depreciation of 775. So this will be your closing NBV. Now this is a little bit technical. I repeat, 32,500 is the original cost and that cost includes land. It's perfect. It includes 5,000 construction cost. It's perfect. But plus 200, what is this plus 200? The additional capitalized interest which we need to capitalize, okay. Then 9,200 is the year starting accumulated depreciation, and then there is further depreciation during the year of 775. So finally you can calculate the closing NBV. Yes, it is technical. I'm telling you, if you're not active you can do mistakes. So okay, now for equipment, what is the original cost of equipment? It's 16,200. 16,200. There was an error of 3,000. Yes, I need to remove definitely. Now what is the opening accumulated depreciation? Opening accumulated depreciation was 8,420, and yes, there is some more depreciation during there, which is 1195. We have just calculated 1195. So this will give you closing NBV. This will give you closing NBV. So this will be equal 16,200 minus 3,000 minus 8,420 minus 1195. 3585. Okay, so if you add these two, you will have 26,310. This is your total property, plant and equipment. This is your total closing NBV of property, plant and equipment. My dear student, use your brain. So I have subtracted opening accumulated depreciation as well, and as well as the for the year depreciation to calculate closing NBV. Okay, now let me fix data. This 26,310 will go in the SOFP. Okay, 26,310. Let me start. So it's, let me pick equal to, okay, I have taken this, and now ROU, closing ROU I have already calculated. This 7631 is your closing ROU. Okay, now the next thing is closing financial asset. Yes, this working I have already done. This working 4175 is your closing financial asset. Three things done. Okay, let me add all these three. This, now inventories you will pick directly from the SOFP. So inventories is 4640. Please check it out. Then you have trade receivables, pick directly from the SOFP, no adjustment, 2810. Then you have other current assets, means that claim receivable. Remember that, what does it mean? Wait, Contingent asset, remember that contingent asset of 1000, claim receivable, we made the entry, it's your current asset. Okay, so wait, let me tell, no, little bit alignment issue, let me align it correctly. Yes, inventories are 4640. Yes, then you have 2810 of trade receivable, then you have again alignment issue. Yes, this is inventories 4640. Sorry, eyesight issue. Trade receivable is 2810. Then you have 1000 of contingent asset. Now let's add all these. So these are your current assets. Now what about the total assets? Total asset means sum of these two. Equal sum this. So 46566, 46566 is your total assets. 46566 is your total assets. Okay. Now let's move to the equities and liability side. So we have like share capital. Yes, share capital is ready-made. You will pick from the balance sheet 14,000. But yes, retain earning. Let me tell you, retain earning, opening retain earning was given. Opening retain earning was given. How much was the opening retain earning? 12.62 million. 12,620. 12620. 12620 plus there is some profit. The new profit for the year was 3009. Okay, so 12620 is the opening retain earning. 12620 is the opening retain earning, and when we add for the year profit in the opening retain earning, you get closing retain earning. Yes, I can tell you there is no dividend, there are no dividends, so we'll simply add these two. 12620 plus 3009, 15629. Okay, so this is your total equity. Now come to the long-term borrowings. Long-term borrowings. Remember there was a long-term loan we have taken for the construction. Long-term loan of 5,000 which was recorded correctly. See the question. You have the trial balance picture of the question. Then you have lease payable. In the lease liability there was one current liability element and one non-current. I just broke current and non-current. So 5667 is the non-current liability. Okay, and then let me tell you what is the current liability of lease payable. Current liability was lease payable was 2400. Let me write right away. Then you have trade and other payables. Yes, I have done working for this. Trade and other payable, I have just done working. See, this is 2980. Just pick it in. Okay, then we have lease, then we have current tax payable of 680. We have current tax payable of 680. Remember, and one last thing, go in, you have the question. Now I can't shift the screen. You have the trial balance. Go and check. In the trial balance, cash and cash equivalent is written on the credit side. Cash and cash equivalent is written on the credit side. That means it's overdraft. How much? It's 210. It's 210 overdraft. You can check it now. So what about your total current liabilities? This is your total current liabilities. Okay, so see this equity side. Please concentrate. Please concentrate. This is your equity side. Now let me tell you what are the total liabilities. Your total liability will be this plus this. Okay, now what about total of this side? What about total of this side? This plus this. 46566. 46566. Yes, it's balance. 46, finally it's balanced. 46566, finally it's balanced. Okay, so just for your information, Please check it out. No issue, no issue. You can still see this. Let me enlarge it. See, this is your equities and liability sides. My respected student, this is your asset side. Okay. And this is the working which you can see. This is the profit reconciliation thing. Everything you have done in the class. This is all normal things. Okay. And I have already covered in detail with the pen. That's why now I'm just going with the pace. See, these are the workings. If somebody want to see, if anybody want to see, these are the workings. I have already done the workings in with the pen as well. Okay. So finally, it's time to say goodbye. The question is done. If you like the class, please comment on this video and give your feedback. You can share with your friends as well. And please, these are the last days, very, very important days. Make a study plan. Don't waste a single day. Do special time for study hub and the last 40 marks practice on the software. Okay. Thank you and take care.